So on that basis, I can see that this is the direction in which it's going. Now, in terms of timing, they're being very, very careful not to undermine the Western financial system. Because if they came out tomorrow and said, right, we Russians are now going on a gold standard, bang, what would happen? I mean, you can see, wow, where does that leave these flaky fiat currencies? In the ditch.
Think. Act. And prosper. You are now tuned into the Money Level Show.
Hey everybody, welcome back to the Money Level Show, where we think, act, and prosper. Today we have a special guest. This guest is the first time. It's his first time on our show. Today we have the opportunity to speak with Alasdair Macleod, who is the head of research at goldmoney.com. Alasdair started his career as a stockbroker in the London Stock Exchange in 1970, and he was an investment manager and an executive director for an offshore bank in a country that I cannot pronounce. So Alasdair, you have a lot of experience. How you doing today?
I'm doing fine, thanks, Daryl. Thank you for the introduction.
Yeah, I went to goldmoney.com and I wanted to kind of just do some more research because I know you've mentioned that in some of your former interviews as well. And I was also looking at the CEO, Roy. I don't know how to say his last name. Sabag.
Sabag, he pronounces it. Yeah.
Sabag. Yeah. And, he's had his hands in a lot of things. The company that I buy my gold jewelry from, I think it's called Monet.
That's right. He set that up. And that was really after he got involved in gold money. Monet was natural because around the world, outside Europe anyway, people buy gold jewelry by weight. And, if you go to India, you see women wearing bangles and, necklaces and all the rest of it. And that's their wealth.
Yep. Exactly. Yep. Exactly. Yeah. And so, and even Monet, like it does 24, they, do 24 karat, in which I remember taking my wife to K Jewelers, and, we're looking for her ring and stuff. This was before we're married. And I didn't know anything about carats or the purity and everything. I think her ring is like white gold. It's probably like 14K or something like that. And so now we're rethinking our wedding rings and such. Is like, yeah, I think we want the pure gold. Like, I mean, silver's cool, but I love silver, but I want the gold on the finger.
Yep, absolutely.
Yep. So another thing I noticed about Roy is he started. He was part of a crypto mining company, Bitfarms. I was wondering if you all. I know I've heard your position on Bitcoin, and I was kind of wondering like how that conversation looks like. Because.
Well, actually, I can't. I mustn't put words in Roy's mouth, but I think his views are not too dissimilar from mine. Mm-hmm. He's a businessman, he will see an opportunity and go for it, and that's basically what he does. I mean, that's how I see it anyway. And he's been incredibly successful. He really has.
That's good. Yeah. Well, I want to get to the interview. I mean, Roy, it was fascinating reading some of his biography, but we're here to interview Alasdair, and so I was kind of wondering, just start us off. M2 money supply has been the worst since the Great Depression. Mm-hmm. And so I'm kind of wondering what is happening here. Like this, that's scary news.
Yeah, I mean, it is scary. I think it's not often that the bank credit cycle gets to the point where it starts reducing the level of outstanding deposits. Because the bank credit cycle really is about reducing the available credit for businesses. But this does seem to be rather severe. There is another aspect, actually, which distorts the whole picture, and that is that large money market funds are, instead of placing deposits in the banks, they are leaving them with the Fed in reverse repos. So quite a lot of currency, which would otherwise be recorded as deposits, actually is being recorded as reverse repos. It distorts the picture. One of the reasons for this is that under the new Basel III regulations, the net stable funding ratio means that large deposits are not a very efficient means of funding the asset side of your balance sheet. The Basel III regulations recognize that small deposits, particularly those which are insured, are less likely to move, sort of suddenly and sharply and create a run on the bank's funding position. So there are a number of special factors this time round. But nonetheless, we do have a credit crunch, which is a phrase which we used to use in the past. The banks have got themselves over-leveraged. They've got very little balance sheet space. And instead of looking at profitable opportunities, bank directors are now looking very much at curtailing risk. It's a completely different emphasis. And so we will see, I think, a continuance of this. And there is another aspect of this which I don't think people appreciate, and that is that when banks start restricting the amount of risk, what happens is they drive interest rates up. So the idea that interest rates are under the control of the Fed is not the case anymore. And the same is true in other jurisdictions as well, like the ECB, and the UK. Japan is a slightly special case, but it's bound to be true there as well because of the very highly leveraged position of the Japanese banks. And the reason this happens is that when you get a contraction of credit, what it tends to do is it increases demand for credit, because businesses when credit starts to be restricted, inevitably economic activity slows down. They end up with inventory piling up, unsold inventory. They've still got their costs. And at a time like this, with inflation being a problem, inflation of prices, that is, inflation of wages, the costs are continuing to rise. So they need more, if you like, overdraft space, what they used to call revolving credit. It's very difficult for businesses who find that their banks turn around and say, well, we know you had an overdraft of $1 million. That, I'm afraid, we're going to have to cut back to $500,000, and I'm afraid we've got to raise the rate. And that's the situation which, forget the big corporations, but just think about the 80% of businesses which are small and medium-sized businesses up and down the country, in the small towns, in the smaller cities, away from the financial conurbations, away from big business. These are the ones that are suffering, and they're the ones who have yet to really hit the headlines. So that's roughly where we are. We're in the early stages of a credit crunch. And I think an aspect that follows on from that, Daryl, sorry, I'm probably anticipating some of your questions, but an aspect that follows on from that is that because interest rates, I mean, I'm talking about real interest rates, the ones at which you are forced to borrow, because they continue to rise, this, I think, will intensify the banking crisis, because it ends up putting the squeeze on a lot of the smaller banks. So this is a very difficult situation for the Fed to navigate through. It no longer has control over the interest rate outlook. It has the problem of a prospective slowdown in the economy leading into a recession. And of course, the other thing is that rising interest rates are going to make it more expensive for the government to fund its deficit. So there are a number of things which are, going to create big difficulties in the foreseeable future.
Yeah, that's you said some very, some things that I've never even known, especially with the interest rates. I was under the perception that the Fed controls the interest rates, and you mentioned that the banks can actually control interest rates as well. And then I also want to unpack the credit crunch and the lack of liquidity that exists in the economy, and what that looks like for equities and such going forward. So if you could share more about this credit crunch and how is that going to transition into the markets for especially retail investors and such. That's who I mostly represent. But could you unpack that a little more? Hey everyone, sorry to interrupt this interview, but I want to let you know about this important resource, the Rule Symposium. The link is in my bio. Be sure to click that link and check out the site for the Rule Symposium. This is a symposium that Rick Rule puts on every year. From this year, it's going to be from July 23rd through the 27th, and you're going to be able to hear from some of the best in the space. You're going to be able to shake hands with some of the best in the space. He's going to have guests and presenters such as Jim Rickards, Nomi Prinz, Rick Rule himself, and many others. And these are going to be people that have built billion-dollar businesses, people that have made a lot of money in investing in the natural resource space. So be sure to click the link in the bio so that you can check out the Rule Symposium. That is the Rule Symposium. Check it out. And I appreciate you all for clicking that link and supporting the channel in that way.
Yeah, basically, we have a credit crisis roughly every 10 years. If you go back and look at the cycle of credit going all the way back, you can see evidence of a banking crisis roughly every 10 years, sometimes longer, sometimes shorter. And I'm going all the way back, 200 years in that statement. The way it works basically is that, let's say, the economy has been poor, it's beginning to show signs of recovery. What happens is that the banks, they will have the people who they trust, and they will help them, if you like, sort of reorganize areas of industry. So you will get consolidations, you get takeovers, with really smart operators trusted by the banks. The banks will lend them money to do this. They'll create credit for them to do this. And that process leads to a gradual recovery in the economy. It's a combination of a bit more credit being injected into the economy and the deployment of capital more efficiently alongside with it. That then develops into a more general confidence about the economic outlook. And at this point, what happens is that the banks start competing with each other for custom, decent, credit-worthy people to lend money to. So what they do is they will even cut their rates. They will, cut their margins in order to get the business in. And I've seen that time and time again. And of course, as this develops into further demand for credit, at this stage, the demand for credit is getting just a bit too healthy. And the banks, if you like, under these circumstances, they begin to sort of look at the balance sheets of their customers. They look at the outlook and they see maybe some inflation on the horizon. And they think, well, the business models that these people have been working on look like being threatened by development. So we're going to become a little more cautious. And of course, all the banks have the same sort of intelligence, the same sort of advice from their experts. And there comes a point where this greed, if you like, for profit, which is, greed is a powerful word, but, this desire for profit turns into, a fear of losses. So they then start drawing in their horns. And you don't necessarily see the level of deposits dropping. You don't necessarily see the level of outstanding credit, industrial loans and leases dropping. But what you will detect underneath is that there is a tightening of conditions. And normally what happens is that you get some sort of financial crisis like we did in 2007, 2008. The central bank steps in, rescues the whole thing. We all have a nightmare. This is terrible. This is ghastly. Market goes down, et cetera, et cetera. We all lose confidence. The Fed then injects yet more credit into the system, and then we're saved. And then we're off on another cycle. And so this is the cycle. Now, when I say every 10 years, it's actually now what, 14, 15 years since the last one. So this is very long in the tooth. And I have to say that the ratio of balance sheet assets to tier one equity, we're looking at the highest levels, more or less, in over the last year or two that we've ever seen. I think in America, you're looking at something like 13, 14 times on average. And that is huge. That really is huge. When you bear in mind that in the 1990s, that came up from around about 7 times, you can see the effect, if you like, on shareholders' returns when losses start to mount. They were doing very nicely on the way up, but my goodness, when you get on the way down, you've got to protect your shareholders. This is the primary function of a bank director. So that's what happens. And so they're all drawing in their horns. And as I say, the effect on available credit is to make it more expensive, more scarce. And that, again, increases the problems, because how does the Fed fund under the government spending under these conditions? It has to effectively go along with the increase in interest rates forced upon it by the commercial banking network in order to achieve funding of the government's deficit. So we have a situation where we saw with Silverbank, what happened was that they bought term debt, and they did it, if you like, at close to zero interest rates. They were getting a yield pickup of maybe 0.5%, 0.75% on 10 years. And then what happened? Whoa, it switched like that. Suddenly you had a higher cost of borrowing, a lower return, and capital losses. And putting all those things together is absolute death for a bank. And okay, they could realize sales of government debt very quickly in the market, but the losses, suddenly you can see that these are enormous losses, and they wipe out the capital, because just think, those losses, are on a balance sheet which is 13 or 14 times the size of tier one capital, which is basically the equity element on your balance sheet. So it wipes out your equity very, very quickly. And if you look at the FDIC figures, you get a sort of notional figure for equity. I mean, the equity in the total US banking system is in the order of, I don't know, somewhere between $1.5 and $2 trillion. Now, you're not going to see very much of the way of losses for that to be wiped out completely. And that is a dangerous situation which we now face.
Yeah. So what I'm understanding, even with the banks that have went down, they bought these government debt, and the government debt is paying them, 0.5% or whatnot. Inflation has gone up, and then interest rates have gone up. And so that's where I see like that switch of now, like the government debt would pay more now, but they've loaded their balance sheets up with a lot of debt that doesn't really pay much. And so they're negative in their equity. What happens with, I was kind of wondering what happens with those bonds, those treasuries. I mean, because it seems like there's a lot of them out there where either corporations or banks have bought, and they have to either sell them at a loss or whatnot. What happens with those bonds? Like, are they just on someone's balance sheet somewhere, or do they disappear, or what kind of happens with those?
The only way to make them disappear is for the government to pay them off. So that ain't going to happen. Yeah, I mean, there is another aspect to this, and and that is, what did the Fed do? I mean, the Fed, with quantitative easing, drove down the yields. In other words, drove up the prices of existing government debt and bought it right at the top of the market. It created a top of the market at which it could buy these bonds in huge quantities. I mean, remember, they were doing $120 billion a month QE from March 2020. Oh, for what, 18 months or something? I mean, this was huge, absolutely huge. So they have enormous losses. And not only have the losses wiped out their notional balance sheet equity, but these are losses that somehow have got to be dealt with. And it's easy enough to deal with, but you don't want to have to deal with this in the middle of a banking crisis, for goodness sake. You know, to have the central bank bust and your commercial banks bust, is not a good combination because, I know all this talk about moral hazard and how wicked bankers are and all the rest of it and how they deserve, if they lose their shareholders' money totally, they deserve to go to the wall. Yeah, okay, I understand all that. But in a modern financial system, if you start letting banks like that go bust, you will break the whole system. And that is something that we cannot afford to do. I mean, we very nearly saw this with Lehman. I mean, that was letting Lehman go under was a huge, huge problem. I could understand it at the time because, none of the politicians really understood the risks that were in the market, and it came as a horrid surprise to them. And of course, it was after bankers had been paying out huge bonuses and all the rest of it. You can see the politics behind this was very, very unfavorable. And it's almost as if they needed a scapegoat. But my goodness, they nearly brought the whole system down, pursuing moral hazard. This time, the position is infinitely, well, not infinitely, nothing is infinite, except a few things, but it's very, very substantially worse. And with the central banks themselves, with balance sheets, which are negative equity, and I mean very badly negative equity, we cannot afford to make mistakes. And I think it's very difficult to see how they can get out of this without the loss of confidence, if you like, from markets. Suddenly just derailing the whole thing. This is a very, very serious situation, Daryl. It really is.
Yeah. And so the Fed's been doing quantitative tightening. So to my understanding, they're selling some of the debt off of their balance sheet. I don't know who's buying it or what, but now we have to talk about the U.S. debt ceiling. To my understanding, we had less than, I think it was $5 trillion in debt pre the new millennium, 2000. And now, I mean, this isn't even off balance sheet debt, but now we're raising it. We're at 32 trillion. That's I guess on balance sheet. Doesn't include the promises of Social Security or pensions or whatnot. But now we're seeing that they're trying to raise the ceiling again. Is this like going to be an infinite ceiling raise? Like what happens? What happens with this? Is this when nations go bust or what?
Well, this is not the first time. It's a short answer. In fact, I think I saw someone say this is the 90th raise of the debt ceiling. It's happened so many times. I can't say 90, but so many times it just, I mean, you forget this debt ceiling stuff. I mean, it just gets swept away every time. They come up with some sort of formula, to make it look as if it's disappeared. But no, I mean, they will raise the ceiling again because, otherwise civil servants don't get paid, the army doesn't get paid, and so on. So, one lesson we had from Rome is you pay the army, otherwise you're in trouble. And I think I'm right in saying that Emperor Nero in about, sort of 40 AD, something like that, managed to pay his troops by debasing the denarius silver coin by something like 50%. Well, so what's new? We've seen this before. We're here again. And I think that This won't be the last time you see the debt ceiling raised. It's going to get raised and raised and raised. I mean, it's a charade. The whole thing is a silly, silly charade, because we know that government is not going to rein in its spending. It's not going to stand there and let people go bust for lack of credit. It's just going to do what it can to keep the thing going. And that means raising the debt limit.
Mm-hmm. And so when governments continue to do that, how does that impact inflation? Does it lead to hyperinflation? I mean, obviously, many countries have went to war to kind of, I guess, try to wipe out their balance sheets or whatnot. But what happens in the long term as this continues to happen? We see that other nations are forming together. We have the BRICS that have been coming together and talking about forming a new currency or whatnot. I haven't researched it thoroughly, but I'm just kind of looking at what is the long-term outlook of continuously raising the debt ceiling, and what does that eventually lead to?
Well, I mean, inflation in the sense that a loss of purchasing power of the currency is one of the things that we'll see, because basically when governments finance themselves by expanding the quantity of currency, if you like, at that level, rather than the commercial bank credit, then what happens is that they undermine the purchasing power of the currency. And this leads to rising prices. What it is actually is not so much prices rising, but the purchasing power of the currency falling. And that's a very important distinction to make. It's a combination of that and also the developing banking crisis, which I think is at the point of making foreign holders of dollars very concerned about holding those dollars. And I think proof of this is that in the past, you might have had one or two countries which are anti-dollar, like the Iran or whatever. And sometimes there have been very few of them, but it's been possible to whip them into line, like, for example, Gaddafi, who in Libya, who proposed a new Central African gold-backed currency. Well, look what happened to him. And Saddam Hussein made a similar proposal for a Middle Eastern currency, and look what happened to him. I think it would be wrong of me to say that this is more than a coincidence, but I think that it's generally noted around the world, with all your military bases everywhere, that you do not upset the Americans. So, we have this new phenomenon of multiple countries at the same time thinking, I can't really afford to stay with the dollar now because I can see risk over there. I can see risk with the dollar. So I'm going to open my lines elsewhere. And that's what's going on. And this is actually very serious. And I'm not quite sure how the American authorities can deal with this. They have created the problem for themselves to a degree, because when they sanctioned Russia and lent on SWIFT, which is meant to be completely independent of any government, the SWIFT international bank messaging system, they lent on SWIFT and told SWIFT to cut out Russia. They have effectively made Russia's foreign currency reserves completely worthless. So much so that when President Putin at the St. Petersburg International Forum in June last year, he stood up and said, there were 81 official delegations from governments around the world there, and there were goodness knows how many unofficial government attendees as well. And he said, why hold foreign reserves in dollars and euros when the inflation rate's running at 6%, whatever it was at the time, and you're only getting paid 3%. This is nonsense. You're on a loser. And not only that, but they can cut you off at the knees. The point was well made. So, so everybody's been primed. All the sort of neutral countries, and, they're all saying, well, we've got to be part of someone to protect ourselves. We're not sure that it's right to be America. And remember that America and its allies, call it the Western Alliance, is what, 1.2, 1.3 billion people? Asia is 3.8, and that's within the Shanghai Cooperation Organization. There's a further billion in Africa. There's a further $750 million elsewhere, particularly in South America, Latin America, Central America. So, we're a tiny minority. Now, okay, we're the wealthy minority. We're the clever guys who got all the kit and all the rest of it. But I tell you what, the Asians are rapidly industrializing. The world is changing. And they don't want to be fettered, yet if you like, sort of kept down by us. They're escaping from us. This is a very, very different world, Daryl. And inevitably, it is going to mean that the use of the dollar internationally is going to decline. This is something that the Chinese and Russians wanted to do in their joint arrangement for the Shanghai Cooperation Organization. Also, as much as possible, they want to encourage members of BRICS who really, apart from obviously Russia and China in the BRICS, they're the ringmasters in this, but all the others are basically outside Asia. I mean, we're talking about, African countries, we're talking about countries like Brazil, Argentina looks like queuing up for it, and so on and so forth. They're being encouraged to deal in other currencies than the dollar. And it seems that these moves against the dollar are so powerful, they're even taking in some pretty risky currencies as a replacement. But you mentioned this new currency planned in Asia. This is something which was first mentioned, I think, in about April last year. And a guy called Sergei Glaziev, who's a senior economic advisor to President Putin, has been put in charge of devising a new trade settlement currency centered on the Eurasian Economic Union, which is, the sort of the stance in the middle of Asia, plus Belarus, and obviously Russia and China as well. This is a sort of template which it is thought would, maybe be joined by other Shanghai Cooperation Organization members or anyone who wants to join it, obviously with the permission of China and Russia. Glaziev's thinking, I think, his first statement was that they were looking at producing something which is a combination of the currencies involved and the commodities, perhaps weighted for the commodities which are traded between these nations and so on. That has now moved in various stages. And the last that we heard on this is that Glaziev is planning actually to put the whole thing on a gold standard. This was effectively what he was saying in an article for Vedomosti, which is a Russian business newspaper based in Moscow. An article he wrote on the 27th of December. And he was writing that even more specifically about the ruble. Now, it makes sense for the ruble to go onto a gold standard because if you look at interest rates in rubles at the moment, in the order of sort of 10, 12%. If you go onto a gold standard, then they would decline down towards around about 3%. So that would be an enormous benefit to Russia, a Russian business as a whole, and so it would promote the economy hugely. So on that basis, I can see that this is the direction in which it's going. Now, in terms of timing, they're being very, very careful not to undermine the Western financial system. Because if they came out tomorrow and said, right, we Russians are now going on a gold standard, bang, what would happen? I mean, you could see, wow, where does that leave these flaky fiat currencies? In the ditch. Now, it would in fact effectively be an act of war. I mean, I'm not exaggerating when I say that. So they're not going to do this just like that. What they will do is wait until they're in a position where they can claim, this is our last resort. This is what we have been forced to do by the deterioration of financial and economic conditions in the West. So in other words, as our banking system progresses into deeper and deeper crisis, and don't think this is over. I mean, don't indulge in wishful thinking. You will find there will be foreign selling of dollars. Now, that starts with 7 trillion of bank deposits. And do you know how much the American public and corporations own in foreign currencies? Because if you're going to sell dollars, they're going to be bought by Americans. I'm talking about, foreigners in aggregate, not dealing with each other, but the aggregate position. You've got $7 trillion here. You've got 380 billion other currencies here in America. 380 billion available to absorb 7 trillion. Wow. That's not a good ratio, I tell you. And once that starts, you then got to start looking at the position of American assets, financial assets owned by foreigners. Now, there, according to the US Treasury tick figures, there's a further 24.5 trillion. The ownership of foreign assets by Americans is recorded in the tick figures, same lot of figures from the Treasury, at about 14 trillion. So you've got 24 and 14. Now, when you get rising interest rates, you get a falling dollar, which again threatens to raise interest rates. You've got a crisis developing here. On the cash side, what happens on the portfolio side? Well, you know what happens. Bond yields start rising, equities start falling. So what do foreigners do with these positions? They start selling those as well. What do the Americans do? They start selling foreign stuff as well. But the foreign stuff that they own, 14 trillion, is almost entirely in ADRs, American Depository Receipts. When you sell an ADR, there's no foreign exchange transaction involved. When a foreigner sells a US bond, equity, whatever, or even ADRs in another country but listed on the New York Stock Exchange, there is a foreign exchange transaction because he's going to repatriate the dollars out of dollars into another currency or into gold. I mean, traditionally, it's actually been gold. So what this would do is not only would you see the dollar tanking, you would see markets tanking, and you would see gold through the roof. And those conditions, I think we're literally on the edge of it at the moment. And I mean, the two ways to look at this edge. First of all, you look at the price of gold. That is near an all-time high in dollars. Actually, and this is the bit which is very important to understand, the dollar is at a very close to an all-time low against gold. That's the way you look at it, because gold's purchasing power is just steady like that, just goes on and on and on throughout history. I mean, a few bumps maybe, but that's it. Whereas fiat currencies, down like that. And that's what's happening. So the reason there are over $2,000 to an ounce of gold is not because gold has gone up, but dollars going down. So that's the first thing. The second thing is, if you look at the trade weighted index, that's standing at around about 101 and a bit. You look at the chart, if that breaks under 100 or even under 100.5, then dollar's toast. It really is, compared with other currencies. So it's all on a knife edge at the moment, Daryl. It really is. And I don't think people actually understand just how critical the current situation is.
Yeah. And the way you paint that picture, it sounds like we're past the point of no return. We're
rapidly getting there.
Yeah. And I just don't know how they would turn this around. So a couple of things, that I got from that with the countries across the nation. I know, like here in the U.S., there's been a lot of focus on like equity, and things of that nature. And now it seems like it's on a global scale where, countries that have billions of people are still, using carbon emissions and energy and such. And they're like, hey, y'all can focus on, the clean energy or whatnot. We're still going to use oil and coal so that we can continue to industrialize and get our people online to get a sustainable amount of energy. So I kind of view that as in that sense. Another thing is in regard to holding gold and like me, I hold physical precious metals. A lot of my audience does as well. And, I view it as less of a speculation. I don't don't really look at the price much or anything like that. I just hold it so I can sleep at night. What's your advice to people who don't own gold? I mean, I know a lot of people that don't own it, and they don't really fully understand this, and I kind of, am like fearful for them in a lot of ways. And so what's kind of like your advice to them?
Well, the way you've put it, Daryl, I would say to them, listen to Daryl. No, okay, let me put it another way. When you buy physical gold, what you're doing is you're selling credit. You're getting out of the credit system. When the credit system is very dangerous and it looks like it's going to topple over, you don't want to be in it. You don't want to have everything in it anyway. So gold is your escape route, because gold is real money with no counterparty risk. That's the key. And when you buy gold, selling dollars, selling euros, whatever it is your currency is, you don't intend, or you should not intend, to look to make a profit in dollars or euros or whatever, sort of, I'm going to sell this at $3,000 or something. No, that's totally wrong. You misunderstand completely the objective of owning gold, physical gold. You will end up spending it. Or you might release it if the powers that be wise up and actually put their currency onto a gold standard. Now, at that stage, owning everything in gold becomes quite superfluous. I'm not saying that you immediately sell your gold, but such a move would actually stabilize your economy. But in part of stabilizing it, it will weed out the bad stuff. And some of the good stuff might get hit as well. So, the risks aren't immediately over. But once you are back onto a credible gold standard, and it has to be something that is credible and you would judge would last, then at that stage, you can start deploying your capital productively. You'll be able to buy properties. You'll be able to contemplate making things. You'll be thinking, right, what are people going to need over the next 5 years? Where are my skills? How can I deploy those skills? And I've got a bit of capital behind me now to back that skill. You can start thinking positively like that. The thing that's so debilitating about the current situation is you just cannot think positively about, going out and providing things that people need. And I think that's the big sadness of it. But anyway, getting back to the main point, the point you make is absolutely right. You hold your gold, you get out of credit, and you don't care moment to moment what the price is. It's completely immaterial. You just sit there, sleep at night, and just pray it doesn't happen, actually. Mm-hmm. But I'm afraid it is extraordinarily dangerous times. And I see these dangers as being extremely likely to happen. I think the time for kicking the can down the road has pretty much come to an end.
Yeah. And what you mentioned there, I was wondering, so like if we hold gold and say that your nation, whatever nation whoever's listening to this, and they go on a gold back standard, in order to do that, they have to reprice gold, correct? Like in the 30s, whenever they, I think it went from $25 to, and then once they confiscated the gold, they repriced it to $35 an ounce. Is that correct? They'll have to reprice it to kind of balance out the debts or whatnot.
No, not that. That's certainly what they did in 1934. Yes. But this repricing is something that has to be done in the market, mm-hmm. not by governments, because there has to be a market price which they can at which they can exchange dollars, yuan, whatever. I mean, that's the only way it actually works. I suspect that what the Chinese and Russians will do is they will perhaps encourage their citizens to accumulate gold ahead of an announcement that they're going back onto some sort of gold standard. Now, I don't think that, I mean, if I was doing it, this is the way I would do it anyway, I would make an announcement that in 6 months' time, we will fix our currency to the price of gold so that it becomes exchangeable on demand by anyone at that fixed price. We will allow the market to set the rate. We're not going to set the rate. And then what happens is that people in the market sort of start thinking seriously about what that rate should be. And you will find that in less than 6 months, that the new rate will emerge. And then you can fix it. Then you've got something credible. If you try and do it any other way, it's not going to be that credible, in my view. So that, I think, is the way it would happen. And I think the key thing is don't look to the authorities to do this. If the authorities try and do this, if they try and say, right, we're going to fix it at such and such a rate, just like that, then, it would be a big, big mistake. It's not the way to stabilizing the value of credit, which is really what we're looking at. Mm-hmm. Because all economies exist on credit. I mean, we do. Even when you've got a gold standard, you don't go out and spend your gold coins. Silver coins, small change, yeah, maybe. But you don't spend your gold coins, that's for sure. They just stay in the drawer. You go along to the bank. And say, look, I got this idea. I'm going to need $1 million in order to, and here's my business plan and all the rest of it. And if you can convince the bank manager that your plan stacks up and all the rest of it, he'll say, okay, there's $1 million in your account now that you've signed the documents and all the rest of it. Yep, that's absolutely fine, Daryl. You go ahead. That's what you do. You're not going to be cashing in your gold to do it. Mm-hmm. That will stay in the drawer. Or if you become really confident that the standard is really going to hold, then you don't have to have your money tied up in gold coins. And interestingly, the Swiss have never really owned much gold because they've always trusted their central bank to hold the gold on their behalf, in effect, and underwrite the currency. Oh dear, what fools.
Yeah. So that kind of brings me to just a couple things before we end. How does silver play into this? Do you view silver as just more of a speculation, or do you feel like it will have a role for like the average person if gold, the price of gold goes too high? I imagine that silver would follow, and that would be the more affordable option for people.
Well, I mean, yes. I mean, silver is, if you like, a monetary metal. It's not accepted as such by the central banks. The central banks will accumulate gold. The role of silver is very much more industrial now. Now, that said, you still have this traditional market relationship that when you get concerns over the future of credit, whether the purchasing power of credit is going to decline, then people will buy silver. And you find that when the price of gold rises, which is a reflection of those concerns, the price of silver will rise roughly twice as fast, slightly less than twice as fast. So I think it's quite reasonable to suggest that when the purchasing power of the dollar falls so that you've probably got 3,000 to the ounce, then at that level, the price of silver will be considerably higher than the current level. I mean, I think at this stage with a gold to silver ratio of around about 80, just a bit less than 80, you can see that the potential for that ratio to come down to something maybe between 50 and 30 is very much there. What I would caution against is the idea that silver will really come back as a monetary metal because its industrial use, I think, means that, well, for a start, there are not the above ground stocks anymore. And I think that they could well come back to replace, if you like, the coins that we have today, which are just tokens. I mean, they're not, they're made of brass, for goodness sake, or whatever, or nickel. They're not silver anymore. They're not even pure copper. So when you go back onto a proper metallic gold standard, I think silver will have a role. But at this stage, it's difficult to see that the authorities in your country, my country, whatever, will actually bring it in for small change. And in the old days, I think I'm right in saying that silver was legal tender for amounts of up to £10. That's the sort of arrangement which makes an awful lot of sense. But we're talking about the time when a pound was a sovereign, and now they're £400 to a sovereign. So you can see what's happened to, things. There's been a lot of change. We'll have to see. I mean, I would take the view that gold goes up, silver goes up with it. And it probably goes up for twice as fast. But I really wouldn't ride that one until you're back to sort of Isaac Newton's 15.5 to 1 gold silver ratio.
Yeah. Thank you for sharing that. And then the other thing, what does the role, or will it play a role in the coming global economy is Bitcoin and cryptocurrency. There's been a lot of development and work around it, but governments aren't buying it. I think outside of El Salvador or something else. But does that have a role in this new world that we're entering?
Well, I'm sorry to say not, because logically, if Bitcoin was to have a use as a currency, what you would have is a complete breakdown of government. That would be, if you like, the precursor or the condition upon which this would occur. I'm not advocating that sort of anarchy. I think they're going to be very rough times, but I hope that society stays together and the implements that keep society together are intact. But there are two other things, Daryl, which I think are very important to understand. The first is that that money has a special position in property law. If someone steals your wallet and it's got fistful of dollars in it or even gold coins, and that person goes and spends it in the local shop, and you can identify, because you've made a note of the numbers and all the rest of it in shopkeepers too, you have no claim on that money, because if he took it off the thief in good faith, not knowing it was stolen, not being a party to the theft, then the property and that money has passed to him. So that's the end of that. Now, any other property, if it's stolen from you, like, a nice painting on the wall or something like that, or, memorabilia sort of stuff, that gets stolen and you find it somewhere else in someone else's possession, even though that person bought it in good faith, believing that it was properly for sale, you can claim that back. It's your property. You haven't lost it. And furthermore, the poor guy who ended up buying this, unaware that it was stolen, is entitled to no compensation whatsoever. You don't have to buy it off him. It's your property. It remains your property. Right, now we come to Bitcoin. Bitcoin is not money legally. That's the first thing. Secondly, it's got a blockchain. So it is perfectly possible to trace the ownership of Bitcoin going back to when the Bitcoin was first mined or, whatever. Now, let us say the American government is on the search for funds which are the result of crime. They will look at Bitcoin, and if they detect the ownership from someone who is suspected of money laundering or whatever, they trace it through the blockchain and they come to you and they say, "Oi, we have evidence that this is the proceeds of crime. Give us your key, because we're going to confiscate them." And there's nothing you can do about it. Okay, you say, well, you don't have the key. Well, okay, they'll lock you up in jail until you pass with it. So, you got absolutely no defense. And furthermore, if you went and bought it the other day from one of the exchanges, The exchanges have to, they'll know exactly who you are. They'll have done their, anti-money laundering checks, know your client checks, and all the rest of it. You're all on file there. They can trace you. It doesn't matter, and that's gone. So that's the legal point is actually something which is extremely important. And the whole of the Bitcoin community, ignore it, but ignore it at your peril. Right. The final reason why it will never work. As I said earlier, there is a difference between money, which is physical gold, tangible money, no counterparty risk, and credit. The gold doesn't circulate. It's the credit that circulates. So when you have money, you've got to have the ability to create credit on the back of it. So imagine you're going to set up a factory, you're thinking of setting up a factory. Now, it's going to take you, say, 5 years from getting the plans passed to something actually coming out the other end in terms of sales and going into the market. So you've got to fund this. You've got to have credit for 5 years. You may be a very wealthy man and you can do it off your own bat. Fantastic. But most of us are not in that position. And most of us don't want to be in that position. We want to deploy our money in different ways. So what happens? You have got to come up with a business plan. Now, the important part of the business plan is knowing what the value of your sales are at the end of the day. Now, if you're pricing your sales at Bitcoin in 5 years' time, what's it going to be? You've got no idea. It's just impossible. And if you talk to these Bitcoin freaks, they say, oh, it's going to be 10 million bucks each or something. What? Is that what I've got to repay at the end of the period when I'm only borrowing about a current 23,000 or whatever the thing? Do you see what I mean? It cannot work as a basis for credit. Forget it. It's complete nonsense. So that's my answer. Now, as a speculation, have fun. That's your
for sure. That's I have my criticisms of it as well. I will speculate with it here and there, but I prefer to hold money, which is gold, and that has been money for thousands of years. So, I don't negate that fact. Yep. Well, Alasdair, thank you for.
As I say to your friends, listen to Darryl.
For sure. Well, thank you for coming on today. I appreciate you being here to share your knowledge and wisdom with the audience, and I hope to have you back on soon.
Yeah, that would be lovely. Thank you for asking me, Darryl.
All right. You have a good day, Alasdair.